If you're doing everything right with money, but you don't feel wealthy yet, chances are it's because you don't have a money playbook. At least one that's not built off of lies like the majority of people. But not anymore, because in this video, I'm going over the 5 biggest money lies that you need to unlearn so you can rewrite a money playbook that can make you wealthy instead of just working to get by. Money lie number 1, your house is an investment. Stop paying your landlord's mortgage and start building your own equity. We've all heard this before, but let's do some math. You want to go out and buy this $700,000 house. You want to put down 20%, which means you're going to put down $140,000 in cash out of your pocket to purchase this property. Then you're going to get a mortgage. Let's assume you get a 6.5%, 30-year fixed rate mortgage on the remaining $560,000 that you have to borrow. That means your monthly mortgage payment, not including property taxes and insurance, is going to be around $3,500 a month. Now, when you pay this $3,500 a month to your bank, you might assume that half of this money, $1,750, is going to your principal balance to help build this equity, and the other $1,750 is going in interest to your bank. But that's not how it works. Banks are smart. They do something called front-loading mortgages, which means in the beginning, the majority of your mortgage payment is going directly into your banker's pocket with interest, and a little bit is going to actually build equity in your house. I'll show you what I mean. This amortization calculator shows how much of your mortgage payment is going to interest versus principal, and it isn't until year 20 where half of your mortgage payment is going to build equity and not padding your banker's pockets. So in the beginning of your mortgage, $500 a month is going to principal, the other $3,000 a month is going to interest. And if you refinance your mortgage, well, you start this front-loaded interest payments all over again. Now, this is where you might say, well, at least some of that money is going to equity for yourself as opposed to just paying your landlord's mortgage, which you are correct. It's not bad to buy a house. In fact, it's very good to buy a house. I encourage you to buy a house. It's a problem when you buy a house that you can't afford, and it's a problem when the majority of people think that the way you become wealthy is by buying a house and paying it off, and then you have no other forms of investment, because the big mistake that a lot of people make is they assume that when I buy the $700,000 house, I'm going to pay it off. Well, now I'm free, but you still have to pay expenses to live in this property, and you still need an income to support living in this property even if you don't have a mortgage. You have to pay property taxes and insurance. And let's assume that something good happens. Property values go up. Now your home is worth $1 million, $2 million, $5 million. Well, that also means your property taxes have gone up by many multiples. That also means that your insurance has gone up by many multiples. And now you need more money to pay for those expenses. So if you're retired and you have no income, well, you're going to have a tough time paying the bills to keep living in the house. If you pass this house down to your kids, they're going to need money to keep paying for those property taxes and insurance payments. Not to mention, you need to keep paying for the upgrades. Not to mention, if you want to upgrade the basement, you have to pay for that as well. This is why I always say, treat your house like a liability. Whether you own a house or rent a house, treat it like a liability, make it an expense. If your house goes up in value, great. If you sell it for a profit, great. It's great to own a house, but the key is to own investments outside of the house that you live in. It's great to own a paid off house. I encourage you to do that. I encourage you to buy a house, but make sure you can afford it first. And that means you gotta afford the down payment, the monthly payment, and the move-in costs, because it costs money to move into the house. And when you move into the house, chances are your wife's gonna want new furniture, she's gonna want some renovations, and chances are she's gonna want some new appliances too. So factor that in. Money line number 2 is your job is what's gonna make you wealthy. One thing that I learned when I was in law school is that legally, it is the job of an employee to make investors richer. I'll show you what I mean. When most people think about becoming successful and becoming wealthy, they're talking about climbing the corporate ladder. How do you go from associate to analyst to director to VP to CEO? This way you can make more money in your salary. But there's one part that most people overlook in this diagram. Who are you actually working to make wealthier? Because the CEO of a company has what's called a fiduciary duty, meaning a legal obligation to make one person rich. It's not the employees in the company, it is the investors in the company. The CEO's job is to make the shareholders rich. And who are the shareholders? Well, this is the investors in the company. So everybody here is working to make this person money. The shareholders, the investors, are working for profit. The employees are working for salary. When you work for a salary, you have to go to work to get paid. You don't work, you don't get paid. When you work for profit, well, you don't have to work for the profit. The shareholders are getting their piece of ownership, their piece of equity, their piece of profit, which they don't have to go to work to earn. Now, some employees will get paid with ownership or stock as a compensation tool, but there's a lot of investors that don't work in the company. For example, Warren Buffett makes hundreds of millions of dollars a year in dividends, meaning profit distributions from Coca-Cola, but he never has to go into the Coca-Cola factory to work at Coca-Cola. And this is the key link that's missing in our education system. We're taught to get a good job to work up the corporate ladder. We're never taught how to work for profit. Wealthy people are working for this. The average person is working for this. If you want to become wealthy, you need to transform your salary into investments. That way you can get the profits so you can actually become wealthy. Again, if you want some more resources on how to do that, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the economy, stocks, housing, crypto, and the global markets into a fun and witty newsletter. Plus, when you join Market Briefs, you'll also get my investing masterclass, which will walk you through how you can start building wealth in this economic system and how you can find hidden investment opportunities that way you can grow and accelerate your wealth. This is a completely free masterclass and a free newsletter. So if you want to get all this, all you have to do is click the link down in the description below to get it all for free. Money line number 3 is you need to be rich to start investing. Let's assume we learn about this financial education stuff early and you start investing when you get your first job at 21. But you don't have a ton of money to invest. So you invest $100 a month, which, by the way, is less than $4 a day. And you never increase how much money you invest. You stick with this $100 a month even when you get raises, and you do this decade after decade after decade until you retire at age 66. So you do this for about 45, let's call it 46 years. Now, when you do this, you're also investing your money and you're growing your money by the average rate of the market. Now, for the last 50 years or so, the S&P 500 has grown by 12% a year. But let's assume you only grow your money by 10% a year on average. This doesn't mean your money always goes up, but you average 10% a year. Well, now when it comes time for you to retire, you're gonna have over $1,045,000 from a small little $100 a month investment. Everybody can start somewhere. If you have $5 a day, start with that. You have $2 a day, start with that. You have $1 a day, start with that. Start with something and then work to add more. As you earn more money, invest more money, and keep investing your money when markets go up, keep investing your money when markets go down, and over the long term, what we have seen is that this is a proven way to become wealthy. Now you might say, well, Jaspreet, how do I invest my money? Where do I go? Again, you can watch my investing masterclass after you join Market Briefs for some more resources on how do you do that. Money line number 4 is that your banker is a trusted financial advisor. If you go to buy a house or a car or a business, who do you go to ask how big of this asset can you buy? How big of a house can you buy? How fancy of a car can you buy? Or how expensive of a business can you buy? Most of the time, people go to their bank because the bank is the one that's lending you the money, because most people are financing their houses and cars and businesses and everything in between. And your banker is not your financial advisor. Your banker is incentivized to sell you loans. In fact, most bankers are on commission, which means the bigger the loan they sell you, the bigger their commission check is. So when they're thinking about what type of house that you can buy, they're not thinking about, can you make the mortgage payments 6 months from now and still comfortably save and invest and be free. They're thinking about, how big of a house can you buy today? That way I can maximize my commission check. Now I get it, not all bankers are gonna try to maximize their commissions, but they are incentivized by commissions. So you want to keep that in mind, because their best interest is not going to be your wallet. Of course, it's their wallet. Not because they're bad people, but because they have a family to feed as well. It's your job not to look out for the banker's wallet. It's your job to look out for your wallet. And that's where you have to understand the difference between a financial advisor and a banker. There's a saying in the insurance world, if you ask an insurance broker how much insurance you need, the answer will always be more. When you ask a banker how much loan can you get, their answer will always be more. They want to sell you more loans. Insurance people want to sell you more insurance. You need to know what's right for you. your wallet, and your family, which is why when you're coming up with these decisions, you have to have a system of knowing how much money you can spend versus investing versus saving, which is why I talk a lot about a 75-15-10 plan. This way you know how much money you're allowed to save and invest and spend, because what a 75-15-10 plan says is for every dollar that you earn from here on out, 75 cents is the maximum you can spend, 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. And now you know, no matter what you go out and buy, this is the max amount of money that you can spend. And if you can live off of 3/4 of every dollar that you earn, and you're working to save and invest 1/4, well, now you're always working to pay yourself first. You're always working to invest to make yourself wealthy and save. That way you can take care of your finances, because this is what's going to take care of you and your family. This is what buys you the nice stuff. And by the way, once you have enough savings, somewhere between 3 months to 12 months worth of expenses put aside in a separate savings account, well, then you can stop saving this money and you can reallocate that additional 10% here. That way you're investing 25% and spending 75% of your income. And money line number 5, your 401k is enough to retire. I hate to break it to you, but your 401k was never designed to be your full retirement plan. In fact, the founder of the 401k has come out and said that the 401k has gone awry because so many people are using the 401k as their sole retirement plan. That's not what it's made for. It was there to supplement your retirement plan. So if you have a 401k or something similar, great. It's a great place to start. Use it, but don't stop there. That's not enough. You need to continue investing outside of your 401k as well. That way you actually have the financial freedom to do whatever you want when it comes time for you to retire, which brings me to a bonus number that I want to talk about. Bonus money lie. You can figure out money later. There are 3 things that will determine how wealthy you will become, and it's ultimately very simple. TRM. Time, return, money. The better your rate of return, the better returns you get on your investments, the wealthier you're going to become, and the more money that you can invest, well, the more your money can grow. There's only one factor out of these 3 that you cannot get more of. Want to guess which one? It's not money, it's not return, it's your time. And so when a lot of people say, well, I'll start worrying about retirement or investing next year, or when my salary goes to $100,000 a year, or when whatever happens, you put it off until later, what you're doing is you're killing this part of the equation. You can always get more money, which, yes, hopefully you'll work to increase your salary over time. You can work to increase the rate of return, but the one thing that you cannot change is time, which is why the sooner that you start, the wealthier you'll become, and you want to start sooner rather than later. Stop waiting for the perfect time, just get started. Market crashes will happen, recessions will happen, it's gonna happen again. When it happens, invest even more aggressively, but use time to benefit you instead of being on the opposite side of time and wishing you would have started earlier. One of the most common comments that I get on this channel is, I wish somebody would have told me this younger. I wish I would have started this younger. It's people that are in the 30s, 40s, 50s, 60s, 70s, 80s, and even 90s. Nobody over the age of 100 has told me this yet, but people have told me from the 30s onwards that I wish I would have started younger. Nobody says I wish I would have started later. If you have $100 in your bank account and you want to buy this $1,000 Gucci scarf, your bank would love to lend you the $900 at 25% APR, because when you make the minimum monthly payments, your banker gets richer. But that's just the beginning. When it's time for you to buy a house, who do you ask? How big of a house should I buy? Many times it's your banker, and they're not your financial